All right, we're going to talk about Chapter 12 here, cost of capital. So we're going to look at a couple of concepts here, mainly the weighted average cost of capital and something called the SML, security market line, or it's also known as the capital asset pricing model. All right. So the cost to a firm for capital funding equals the return to the providers of those funds. So you've got usually debt and equity in a firm, and so the cost to a firm for capital funding is the required return that both the debt holders as well as the equity holders require, and the return that they require depends on the riskiness of those assets in a particular entity. So a firm's cost of capital indicates how the market views the risk of the firm's assets. The riskier the firm's assets, the higher the required rate of return or cost of capital. A firm must earn at least the required return to compensate investors for the financing that they have provided. And so if they take on any new projects or products, those have to earn at least the required return for those projects, considering how risky the projects are. Understand that when we're talking about required return and discount rates, they're the same thing. All right, so let's talk about the cost of equity. Now you can do this a couple of different ways, but again, the cost of equity is the required return by equity investors given the risk of the cash flows from the firm. So a couple of different ways. One way you've already dealt with is the dividend growth model. The other method is the SML, as I talked about, or another name for it is CAPM, or capital asset pricing model. All right, so if you recall, dividend growth model, you start with figuring out the dividend for the first period. If you know the dividend in the first period and the return and the growth rate, you can figure out the price. Well, if you can figure out the price today, P0, you can turn that formula around and figure out the required return. So that's something we did in an earlier chapter. So you see the reformulated formula down there at the bottom to figure out the required return. So here's an example of that. Your company is expected to pay a dividend of $4.40 per share next year. That's D1. Dividends have grown at a steady rate of 5.1% per year, and the market expects that to continue, and the current price of stock is 50% or $50. What is the cost of equity? Well, you simply take your 440 and divide it into $50 plus 0.051 So that equals 13.9%. And so here, trying to figure out the dividend growth rate might be a little bit of a challenge. And so what you might have to do is take a kind of an average of several years of dividends and simply add them up and average them out using the number of years that you have in your sample. So here you have a dividend of 5.7%, 4.6%, 5.1%, and 4.9%. Okay, so for 4 years, you add those up and divide by 4 to come up with an average dividend growth rate of 5.1%. So certainly that's one way to do it, if there's not like a stated exact growth rate stated by the company. All right, so advantages and disadvantages of the dividend growth model. Certainly, as far as an advantage, it's something that's easy to understand and use. Disadvantages, the main one is that it only applies to companies that pay dividends, and if there's no dividends, you're not going to be able to use it. It's also not applicable if dividends aren't growing at a reasonably constant rate. It's extremely sensitive to the estimated growth rate, and it does not explicitly consider risk. Now, the SML approach takes the risk-free rate and the market risk premium and something called the beta to figure out the required return. Now this beta, it grows as risk grows. And so it goes anywhere from, I guess, 0 to 2, I believe. And so, again, if it's under 1, it's less risky. If it's over 1, it starts to get more risky. The further it gets to 2, the riskier a project or company is. And so here again, the RF is the risk-free rate. So you take the risk-free rate plus the beta and you multiply the beta times the market risk premium minus the risk-free rate. So here we have an example. You got this beta is something that you can find for a lot of different companies. Especially if it's like a New York Stock Exchange listed company or a NASDAQ listed company, they're going to list the company's beta. So here, the company's equity beta is 1.2. The current risk-free rate is 7%. The expected market risk premium is 6%. So the question is, what is the cost of equity capital? So you simply take the 7, that's your risk-free rate, and you add that to the product of 1.2 times 6, which is 7.2%. So here the SML or CAPM is 14.2%, so that's your required return on equity. Let's see. All right, let's talk about the advantages and disadvantages. Notice that the great advantage is that it explicitly adjusts for a systematic risk. It's applicable to all companies as long as a beta is available, whether or not they pay a dividend. Disadvantages. You must estimate the expected market risk premium, which varies over time. You must estimate the beta, which also varies over time. And of course, it relies on the past results to predict the future, which is not always reliable. As far as the expected market risk premium, depending on what book you look at, it's anywhere from 3 to 6%. This book uses 7%. So just kind of depends on what you're looking at. All right, so here's another example. We have a company with a beta of 1.5%. Market risk premium is 9%. Current risk-free rate is 5%, or excuse me, 6%. Analysts' estimate of growth equals 6% per year. The latest or last dividend is $2 per share. The current stock price is $15.65 per share. If we use the SML or CAPM, we would take the 6%, we would add that to the product of 9% times 1.5, which, if you notice, creates a situation where it increases the return beyond the market risk premium. So in this case, it's 1.5 times the market risk premium. So 13.5% plus 6% risk-free rate equals 19.5%. Pretty high. Using the dividend growth model, you take the last dividend, 2 times 1.06, the 6% growth rate per year, divide that into the current stock price of $15.65, and add that to 0.06, and you get, guess what, 1955. So either way, you've got a pretty close estimate. And so it might be a case where what you do is you do both ways, and if you come up pretty close, you have some assurance that your numbers are probably pretty close. All right, so let's talk about the cost of debt. Now, this cost of debt is much more direct and easy to figure out. You can observe this directly usually, whereas you have to make lots of assumptions when you're figuring out cost of equity. So the cost of debt equals the required return on a company's debt. One method is to compute the yield to maturity on the company's existing debt. So if they had several outstanding bonds, you could take all the bonds and figure out the yield to maturity on them and get a good idea of what the cost of debt is. You could also use estimates of current rates based upon the bond trading expected on new debt. If the company had let's say a bond rating of AA, you could find out what companies are charging or what they're selling bonds for at that time. Note here that the cost of debt is not the coupon rate, because that's in the past, that doesn't indicate current market value of the bonds. All right, so here's an example. We've got current bond issue, 15 years to maturity. Coupon rate is 12%. Coupons are paid semi-annually. Current bond price is at a premium of $1,253.72. And so you can figure out the yield to maturity, and that in this case would be 4.45%. And then that's semi-annually, so you multiply that times 2, and you come up with an annual yield to maturity of 8.9%. Now here, what you're doing is taking that yield to maturity, and you have to consider the after-tax cash flows, okay? And so what you're going to do here is you're going to, in this case, use the yield to maturity as your return on the debt, and then what you're going to do is you're going to take the figure out the after-tax effect. And so our yield to maturity is 8.9%. If our corporate tax rate in this instance is 40%, then the after-tax return is 5.34%. Okay, so why do we have to consider after-tax effects? Well, we've always discussed the fact that you have to consider your after-tax cash flows, and when you're incurring debt, a portion of that debt, well, the debt is tax deductible, and it's as if the IRS is paying a portion of your debt, because you get a tax break based upon your corporate rate. And so the after-tax effect of an 8.9% is the difference between 8.9% times 1 minus the tax rate. Here, they're paying, if they have a 40% tax rate, that means that they're paying 60% of the debt. The IRS is paying the other 40% because you are able to deduct the taxes or the interest. You won't see it very often, but sometimes you'll find that a company has preferred stock. And so if they do, you've got a situation where a constant dividend is being paid every period. The dividends are expected to be paid for ever, so they are considered a perpetuity. And we've calculated perpetuities before. You would simply take the preferred annual dividend and divide it into the current stock price to come up with the rate of return for the preferred stock. Here you've got a dividend of 10%. The current price is 111.10. You divide the 10 into the 111.10 and you come up with 9%. And so that leads us to the weighted average cost of capital, which is simply the amount of capitalization you have in both debt and equity. You multiply those weighted average of each to come up with an average cost of capital for the firm. So this average equals the required return on the firm's assets based upon the market's perception of the risk of those assets. The weights are determined by how much of each type of financing is used. Now, normally you're going to use the target weights of debt or equity that the company plans to use, not what they're currently using or used in the past. If the target weights are not available, then use market values as your percentages or as your weights. All right, so here we have some notations. The E is the market value of equity, which is the number of shares outstanding times the price per share. The D is the market value of the debt, which is the number of outstanding bonds times the bond price. And the value is the market value of the firm, which is D plus E, debt plus equity. And so the weights are the equity divided into the market value of the firm, and the amount of, or the weight of the debt is debt divided into the value of the firm. So that gets you your percentages, or your weights, if you will. And also, if there's preferred stock, you have to do that for it as well. And you multiply the weights times the firm's cost of the equity to come up with your weighted average cost of equity. And you take the weight of debt, multiply that times the firm's cost of debt to come up with the weighted average cost of debt. And that's your total weighted average cost of capital. Okay, be back in a second.